or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 181. And in this episode, we're reviewing the performance of the financial markets during the 41st week of 2025, and that is from Monday the 6th to Friday the 10th of October. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off with a report from the World Bank that has raised the growth forecast for China in 2025, despite the ongoing trade tensions with the United States that have rocked the global economy. The World Bank now projects that China's economy will expand by 4.8% in 2025, compared to an earlier report in April, which had forecast a growth of just 4%. This new forecast is closer to China's official target of around 5% economic growth in 2025. The World Bank, however, did not provide a specific reason for the change in forecast, but noted that China's economy has benefited substantially from government support that could fade into next year. For the time being, U.S. tariffs on China are set at 57.6%, which is more than double the rate that was in place at the beginning of this year. On Wall Street this past week, a single social media post from President Trump on Friday morning led to a massive sell-off in stocks that saw the market lose about $2 trillion in market capitalization. Stocks fell sharply on Friday, with the Dow dropping almost 900 points after President Trump threatened higher tariffs on China. The president accused China of holding the globe captive as it introduced tighter controls on the export of rare earth metals, which are a key resource for the tech and defense industries. In addition to the setback with China, the U.S. government shutdown, which entered its 10th day on Friday, also helped to fuel the bearish sentiment in the market. In response, stocks fell sharply towards the closing bell as the Dow Jones Industrial Average dropped by 878 points on Friday and was down by 2.7% for the week as it came to a close at 45,479. Meanwhile, the S&P 500 declined by 2.4% during the week before settling at 6,552. And the tech-heavy Nasdaq Composite saw a weekly loss of 2.5% before eventually coming to a close at 22,204. In the government bond market, U.S. Treasury yields were lower on Friday as investors shifted towards safe haven assets following President Trump's threat of higher tariffs on Chinese imports. President Trump has threatened to impose an additional tariff of 100% on imports from China in retaliation for the stricter controls on rare earth exports. The threat adds to the uncertainty in the markets as investors continue to contemplate the government shutdown that entered its 10th day on Friday. In response, the yield on the 2-year Treasury note was lower by more than 7 basis points at 3.52%, whilst the yield on the 10-year Treasury bond was down by more than 9 basis points at 4.05%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of U.S. crude oil fell by about 4% on Friday after President Trump threatened China with higher tariffs in retaliation for China imposing stricter controls on the export of rare earth minerals. Trade relations between the U.S. and China were thought to be improving, but this latest setback has once again raised concerns about higher tariffs that could slow down the global economy and reduce the demand for crude oil. In addition to that, crude oil prices have also been under pressure as the Organization of Petroleum Exporting Countries continues to increase supply with the intention of recapturing market share. At the end of the week, the price of the global benchmark Brent crude was down by about 3.8% to settle at $62.73 per barrel, whilst the price of the U.S. benchmark West Texas Intermediate crude declined by about 4.2% to close the session at $58.90 per barrel. In the precious metals market, the price of gold once again broke above $4,000 an ounce on Friday and was on track for its 8th consecutive week of gains after President Trump threatened additional tariffs on China, which accelerated the flight to safe haven assets. The rally in bullion is being driven by a combination of factors such as geopolitical risks, as well as economic uncertainty due to tariffs, alongside strong demand from central banks, coupled with investor flows into gold-backed exchange-traded funds, and further supported by the expectation that the Federal Reserve will continue cutting interest rates. Bridgewater Associates founder Ray Dalio has indicated that investors should consider allocating as much as 15% of their portfolios to gold. This move is advised mainly by the U.S. national debt, which now stands at $37 trillion and continues to rise unabated, mainly due to fiscal indiscipline, which in turn is eroding confidence in paper assets and fiat currencies. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular coupon like a bond. The price of spot gold broke above $4,000 for the first time on Wednesday as it went on to hit a new record high of $4,059 and was on track for a weekly gain of about 3.2% as it came to a close at $4,007 per ounce. We now change scene to the Kenyan financial market, and as is the norm, we start by looking at the domestic foreign exchange market, where the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24. Meanwhile, the sterling pound was priced at 173.52 and the euro was valued at 150.35. On the regional front, one Kenya shilling was changing hands for 26.58 Ugandan shillings and 18.96 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.23. Despite the central bank operating a floating exchange rate policy, the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased significantly by a massive $511 million for a grand total of $11.22 billion, which is equivalent to 4.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. However, despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and remained well-funded with the support of the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate declined by 22 basis points from 9.51% the previous week down to 9.29%, and this was after the central bank reduced the central bank rate by 25 basis points from 9.50% down to 9.25%. For more details on the Monetary Policy Committee meeting, please listen to the topical issue at the tail end of this podcast. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 13.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 9th of October, and the central bank received bids totaling to 25.6 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 106%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate declined by more than 3 basis points to settle at 7.89%, whilst the 182-day rate fell by more than 5 basis points and came out at 7.93%. And the 364-day rate was the biggest loser with a drop of 15 basis points to average out at 9.39%. At the Nairobi Securities Exchange, during the past week, the equities market was on a downward trajectory, with the NASI losing the most as it fell by 3.3%, whilst the NSE 25 and the NSE 10 were both down by about 1.8%. This takes a year-to-date performance to gains of 42.9% for the NSE 20, 37.7% for the NASI, 32.6% for the NSE 25, and 32.4% for the NSE 10. The market's performance was mainly driven by losses recorded by large-cap stocks such as Safaricom, which declined by 6.2%, Cooperative Bank was down by 3.4%, and NCBA Bank dipped by 2.5%. These losses were, however, alleviated by gains recorded by other large-cap stocks such as East African Breweries, which increased in value by 1.9%, Equity Bank was up by 1.3%, and Stanbic Bank ticked up by just 0.5%. In the headlines this past week, the Kenyan Parliament passed the Virtual Asset Service Providers Bill 2025, creating the country's first comprehensive framework for licensing and supervising the cryptocurrency market. This bill marks a decisive break from the earlier draft, which had proposed to set up a new standalone regulator by the name of the Virtual Assets Regulatory Authority. The approved bill establishes a multi-agency oversight model that places the supervision of crypto service providers under existing institutions such as the Central Bank of Kenya and the Capital Markets Authority. The use of cryptocurrencies for cross-border transactions is gaining traction in the Kenyan markets, and according to a report from Chainalysis, which is a blockchain data platform that tracks the usage of cryptocurrencies, in the 12 months to June 2024, Kenyans transacted in stablecoins to the tune of about 426 billion shillings, which is equivalent to $3.3 billion. For your information, stablecoins are a form of digital currency that is pegged to a traditional asset class like the US dollar and is designed to maintain a stable value. Up next is our topical issue, and this week we're looking at the latest decision by the Central Bank's Monetary Policy Committee. The Central Bank's Monetary Policy Committee met on Tuesday, the 7th of October, and during its deliberations, the committee made the following observations. Global growth remained resilient in 2025, supported by front-loading of exports to the United States ahead of implementation of higher trade tariffs, as well as improved financial conditions and strong consumer spending. However, heightened geopolitical tensions in the Middle East and the ongoing conflict between Russia and Ukraine remain a key risk to global economic growth. Meanwhile, global inflation is projected to decline in 2025, mainly driven by lower energy prices, as the price of crude oil has moderated due to increased production and subdued global demand. Central banks in the major economies continue to remain cautious in easing monetary policy as the risk of higher inflation persists due to the uncertainty around the U.S. tariff policy. On the domestic front, the latest data showed that the Kenyan economy remained resilient as the gross domestic product grew by 5% in the second quarter of 2025. And this is compared to a growth rate of 4.6% for a similar period in 2024. Meanwhile, the cost of living in Kenya ticked up slightly in the month of September as the overall rate of inflation came out at 4.6% compared to a rate of 4.5% in August and still remains below the central bank's midpoint target rate of 5%. Barring any external shocks to the domestic economy, inflation is expected to remain stable in the near term, supported by continued stability in energy prices and the exchange rate. In the 12 months to August 2025, Kenya's current account, which measures the net position between imports and exports, this recorded a deficit valued at 2.1% of the country's gross domestic product and was a reflection of higher imports of intermediate and capital goods. The banking sector remained stable and resilient with strong liquidity and capital adequacy ratios as the ratio of gross non-performing loans declined from 17.6% in June down to 17.1% in September. The committee noted that the revised risk-based credit pricing model, which will be fully operational by March 2026, this will help to improve the transmission of monetary policy and enhance transparency in the pricing of loans by commercial banks. The demand for credit continued to improve in line with the decline in interest rates as lending to the private sector grew by 5% in September and as the average lending rate offered by commercial banks declined to 15.1%. Having considered the above developments, the Monetary Policy Committee concluded that there was scope for further easing of monetary policy and therefore decided to lower the central bank rate by 25 basis points from 9.50% down to 9.25%. This action is aimed at stimulating lending to the private sector and ultimately supporting economic activity, whilst at the same time ensuring that inflation expectations remain firmly anchored and that the exchange rate continues to remain stable. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, you don't need to tell me what you believe, but rather show me how you treat other people, and I will tell you what you believe. Think about it. Thank you, and God bless.